Hi again, welcome back. This is Module 2 and you and I are going to cover some of the standard finance terminology. In fact, finance, more than any other profession, has probably got more than its fair share of specialist terms and jargon. And throughout the modules, I shall be introducing those as we go through. But for now, let's get a few basic ones out of the way. Just before I start, as you can hear, I'm English, although I've spent half of my life working for American organisations, so I tend to use the pound or the dollar as the unit of currency. It may well be that you are in another part of the world where you'll be using some other currency, such as yen. I'm sure you'll agree it doesn't really matter what the currency is. What's important is you understand the techniques and approaches. That said, let's make a start. First up then, I want to clarify the term accruals. Now, all they really mean is they're adjustments for either revenues that have been earned, or they could be for expenses that have been incurred, yet are not yet fully recorded in the accounts. You see, the accrual basis of accounting records revenue at the moment when sales are made, and records expenses when these actual costs are incurred. I'm sure you can see that for a typical business, it's highly unlikely that those two transactions would occur at the same time. Now, because it's important that the timing of revenue and expenses need to match, we use the accrual system. For example, suppose that your business needs to purchase some raw materials in order to create your product. You may order those raw materials and then the supplier gives you an invoice and those materials will be paid for at some later date. Hence the need for accruals. Let me give you a simple example. Suppose that a DIY shop buys 100 cans of paint for $2 each, and that in 1 week period, 50 of the cans are sold for $5 each. So you can see they've made a profit. Now, the income for that particular week is $250, because of course they sold 50 cans of paint at $5 each. However, the costs associated with the week's sales are $100. That's of course 50 times what you paid for them. $2 each. And here's the point. The shop would only show these income and cost figures in its accounts for that accounting period, even though it bought in more stock than it sold. In future weeks, they'll still be selling tins of paint that they bought in that particular accounting period. So the costs of purchase of those remaining cans of paint would not be shown in the accounts until they were sold. So this is a very simple example of what accruals are and why they're needed. I'll take you back again to the accounting formula. The timing of revenue and expenses need to match, even though they may not occur at the same point in time or the same accounting period. Let me give you one further simple example. Let's suppose you're making a single payment for internet rental, something I've just recently done because I've moved. But the payment covers 3 months' rent, in which case in your financial records, the rental amount would be spread across the 3 months. Now, there are 4 aspects, or principles, if you will, of accounting. So this isn't just terminology, it's, if you like, the best practice behind everything that we'll be doing. The first is called consistency. As you might imagine from the word, this is where financial definitions and practices should be consistent within a particular organisation over time. You can imagine the confusion if you change the metrics used, for example, from one financial period to another. And this is so that trend comparisons can be undertaken. Where there are charges, then these need to be communicated in the form of prepared accounts, as you might expect. Another principle, if you will, is called prudence. If you're in the UK, you'll be familiar with that word being used often at budget time. And here's an example. Losses, which could be a risk of future bad debt, should be recognised in the accounts as soon as they are identified. So a worst case scenario is reflected in the financial reports. This is prudence. Another example is that gains should be reflected only when they are definite, that is, once the customer is invoiced. Prudence therefore means taking the careful, reasoned approach. And by the way, prudence is often the main reason for tensions between finance and sales teams. Sales teams get recognition for sales made. And directly someone said yes, they wish to buy. The sales team wants it recognised in the records, whereas your finance department will want to follow the best practice of prudence. Next up, separability. This is not as hard as it sounds. An example here makes this quite clear. Suppose you have a sales of $100,001 and you have costs of $100,000. It would not be sufficient to say we made a profit of $1. Why is that? Well, we need to know all about how this was arrived at. In other words, there's nothing inferred, even if it was only $1, as the difference between sales and costs. Sometimes it means stating the blindingly obvious at the time, but when referring to such financial records later, there may be some cause of confusion. Separability makes sure that that doesn't occur. And the fourth and final one here is going concern. And you've probably heard that term already. What this means is that accounts are prepared on the basis that the organisation is going to continue to exist and therefore continue trading for the foreseeable future, going concern. So its assets are shown at the value they provide to the current and ongoing operations of the organisation, not at the level they might reach on the open market. And that's important. Next up, asset. You'll hear a lot about that as we go through these modules. This defines something of value that is owned by the business, or possibly to which the business has a right. These assets are divided into different categories, typically fixed and current assets. More of that later. And I want to introduce a very important fundamental equation here, although we'll deal with it later, and that's that assets equals the equity in the company plus the liabilities. Just make a note of that for now. It'll become clearer later. Another piece of jargon you'll come across is liability, but this has a very distinct meaning in financial terms. It is something that is owed. It's an obligation. In other words, the organisation is liable to ensure that whatever the liability is, usually repayment, is met. Expenses. Now, we're all familiar with filling out expense reports, perhaps for our recent sales trip, and this, of course, is money that is paid out by the organisation concerned. Fairly straightforward. Now, revenue, turnover, otherwise known as income. This is money earned by the organisation. Now, before we go any further, there's no way you can read these once and fix it firmly in your head. You'll find you'll want to come back to these after we've covered some more material in other modules, and that's quite normal, so expect that to occur. The way in which you really get to understand these phrases is by carrying out some of the exercises and for me to show you when they're being used in future modules. Next up, now in the USA, this is called accounts payable. In the UK, it tends to be called the purchase ledger, and you'll come across this a lot in finance. There are many, many different terms meaning the same things, but here I'm introducing the main ones, and differences from country to country is quite typical. So let's understand what we mean by accounts payable or purchase ledger. This is a record of whom the organisation has bought from and the amount owing, i.e. payable, back to them. As you might expect, the word purchase in purchase ledger tells you exactly what it is, and the word payable in accounts payable also makes it clear what we're talking about here. Okay, on the other side of the coin, accounts receivable. That's what it's called in the USA. In the UK, the term is sales ledger. What is this? It's a record of whom the organisation has sold to rather than bought from, and the amount they owe us. So again, the word receivable in accounts receivable makes that clear, and sales ledger in the UK is the money owed from sales. Profit and loss. We'll be looking at the profit and loss statement or report in a lot of detail in later modules. So very important term, and it should be fairly easy to see what they're talking about. So it's a summarised record of all the revenues and along with costs of an organisation over a stated time. So the profit and loss account or statement is for a period of time, very often a financial year. Sometimes you might produce them at the end of each quarter. And a profit is achieved when the revenues exceed the costs. So another important formula there that I'm starting to introduce. And that is that profit, therefore, must equal the revenue There it is, minus the expenses, or costs if you will. And if the revenue is more than the expenses, you've made a profit. What we'll learn as we look at financial reports such as the balance sheet, that's not quite as obvious as it sounds, because as I said earlier, often ordering something, receiving goods, for example, and actually paying for them can occur at different points in time. And since a balance sheet is a snapshot at a point in time, you may find that you've bought some things, but you've yet to pay for them, and that won't occur until the next financial period when you create a balance sheet representing that precise point in time. And talking of balance sheets, this is a snapshot of what the organisation owns and what the organisation owes at a single point in time. If anyone has moved house recently, and I have, then you'll know all about sitting down carefully, in my case with my wife, and making sure exactly what it is we own, what our assets are currently, and what we owe, so that we can determine whether we can afford to move or not. So although we wouldn't call it a balance sheet, we are thinking about balancing these two important aspects. Cost centre. Now, I've been a cost centre manager in engineering, as it happens, where I have my own cost centre report generated each month, and I would be expected to report out to my immediate bosses on how we're doing. Now, a cost centre is a team or a business area, or maybe a department, that only incurs costs. You'll see shortly there's something called a profit centre, which is the reverse. It's expected to make a profit. And this is where a team, business area or department that incurs costs yet also generates revenue. Again, I spent 3 years as what's known as a product manager, where I had a portfolio of price book products that, along with the costs involved in selling and marketing those products, that I had to capture. So there's the difference. A cost centre does cost, a profit centre incurs cost, but also generates revenue. And we hope that the revenue is greater than the cost, otherwise we won't be making much profit. Next up, financial accounting, a very general overview term here. You'll recall I covered this in the first module, and that was the difference between financial accounting and management accounting. So let's just refresh our minds. Financial accounting has the focus of external reporting, of looking back at historical information against fixed timescales in line with statutory or regulatory requirements. This might mean, for example, your fiscal year, and includes the following aspects. Let's just check 4 of these out. It contains the main financial reporting statements, including the balance sheet and profit and loss. And I'll be going through all of these in detail over the coming modules. It includes the recording of accounting transactions and the analysis of external financial reports, and also the differences between profits and cash. All sounds fairly straightforward, doesn't it? There's a lot of detail to cover here, but that is broadly what we mean by financial accounting. Equity, another common term which you've almost certainly come across already. Equity, normally called owner's equity, because we are, after all, talking about a business here, a separate legal entity, is the difference, that's important, between the value of the assets and the value of the liabilities. Again, that's pretty straightforward, isn't it? Let's remind ourselves here that assets equals equity plus liabilities. And my simple example, owning a car worth $20,000, that would be seen as an asset. But if you owe $8,000 on the loan against that car, that's your liability. Therefore, the car represents $12,000 worth of equity. Good. So now I want to spend just a few moments talking about limited companies and shareholders. Again, you're probably fairly familiar with these broad terms. Now, limited liability companies are a framework for investors to make money. Let's be quite clear here. But enshrined in company law, most of it developed in the 1800s in the UK, there's some very clear legal definitions. Now, the legal protection available to the shareholders of private and publicly owned corporations, under which the financial liability of each of those shareholders for the company's debts and obligations is limited to the par value of their fully paid up shares. So if you own 100 shares in an organisation, the only liability you have is the value and the ratio of your shares versus the total shares. Now, the company itself, or organisation if you will, is a separate legal entity, and it is the company that is liable for the rest after your obligations are dealt with. Such an organisation, it can also be called limited personal liability. Now, the organisation converts its resources into products and services to be sold at a profit and provide shareholders with their expected return. This is the basis of the deal, and you'll often find, usually on newspapers, the internet or television, that shareholders are seen as rich fat cats just taking their profit. But in fact, shareholders may be people like you and I. One of the organisations I worked for, an American one as it happened, I had bought shares in the company itself. Rather than putting my savings in a bank, I invested it in shares. Therefore, it's to be expected that a company that sells shares, that the shareholders get a due and fair return on their investment, which of course comes with risks. So investors put their money into company by buying shares and expect a better return than from investing money in other ways. I don't know whether you've done the sums, but putting your savings into a bank gives you a fairly poor return, which is why buying shares, certainly over the past decade, has become very popular with normal folks just like you and I. Certainly the internet has helped that occur. So the cycle here looks something like this. Shareholders give an organisation investment. With that, it's used to invest in resources, which creates products and or services or both, and hopefully make a profit. And that continues. The phrase is grow or die. And the reason why they use that phrase is because basically value is added at each step with a pressure for constant growth. You'll know that where you get profit figures given, in the Financial Times for example, that the shareholders expect to get a profit out of it. And that's why you need constant growth. If, however, your growth is less than shareholders' expectations, then this will have an impact. Share prices will drop. One of the golden rules for a CEO, or in England, a managing director of a company, is that they set shareholders' expectations. If they're not going to have a very good year or a very good quarter, it's best to tell them up front so it's not a surprise. That way, you won't have a sudden drop in share prices. So just a little piece there on limited companies and shareholders. We'll see why that's important as we go through the remaining modules. We'll be talking about shareholders quite a lot. So that's it. Just a quick look at some of the jargon and some of the definitions in the world of finance. There'll be plenty more to come, but for now, thank you very much for your time and attention. I'm almost certain you'll want to go back and watch this video at least one more time and start to get very familiar with some of these definitions. It's the bedrock upon which the next modules will be built. And we'll meet again on the next module, which will be looking at accounting principles. Bye for now.